Good afternoon, everyone, and welcome to the Perpetual Equity Investment Company Half-Year 2020 Investor Update. My name is Karen Davis, and today I'm joined by Nancy Fox, Perpetual Equity Investment Company Chairman, and Vince Pezzullo, Perpetual Investments Deputy Head of Equities and Portfolio Manager for Perpetual Equity Investment Company. Before we begin, I just have a bit of housekeeping to start with. All participants will be in a listen-only mode during the presentation. And everyone who has registered for this update has been emailed the slide pack this morning. If you've not received the slide pack, please visit the company's website, www.perpetualequity.com.au, and you can download the presentation from the ASX announcement section. We'd encourage you all to ask a question today, and you can do so at any time during the presentation. If you're logged in via the webcast, please click on the Ask a Question tab on the top right corner of your screen and submit your question. If you wish to ask a question via the phone, please press the star key followed by the number 1 on your telephone keypad. All questions will be attended at the end of the presentation. I would now like to hand over to our first speaker, Nancy Fox. Over to you, Nancy.
Good afternoon, and thank you for joining us for an update on the Perpetual Equity Investment Company Limited, or PIC, by its ASX code, as I'll reference throughout the presentation. My name is Nancy Fox, and I am the Chairman of PIC. Before we begin, please kindly note the important information that accompanies today's presentation, as you will see in slide 2. Turning to slide 3, you will see the agenda for today's presentation. I will start by telling you a bit more about PIC, the board, and the company's half-year results. I will then hand over to PIC's portfolio manager, Vince Pezzullo. Vince will provide information on market conditions, the portfolio, including offshore opportunities, and investment performance. We will have time at the end of the presentation to answer your questions. So let's begin. For those of you who might not be as familiar with the company, PIC was listed on the ASX in 2014 to help investors conveniently access a portfolio of high-quality Australian and global securities to provide growing income and long-term capital growth over a minimum 5-year investment period. Paramount in achieving our goals is the company's relationship with Perpetual Investment Management Limited and Vince, who you will hear from shortly. The company leverages the resources of the entire Perpetual Investments team, who has a proven track record of investing excellence with a focus on value and quality. PIC's investment strategy is to hold an actively managed portfolio of quality securities. More specifically, up to 100% of our funds can be invested in Australian-listed securities, typically with a mid-cap focus. However, up to 25% of the portfolio can be invested in global listed securities. This is an important feature of the investment strategy and allows the portfolio manager to take advantage of opportunities outside Australia. 25% of the portfolio can also be held in cash to provide downside protection and flexibility to act on investment opportunities as they arise. As mentioned, the portfolio is actively managed, which means the portfolio manager is actively modifying the portfolio based on market conditions and new opportunities. As a guide, the portfolio is typically made up of 20 to 40 stocks. Turning to slide 6, I will take you through the company's half-year results. The company delivered a half-year operating profit after tax of $10.5 million. This represents a strong turnaround compared to the first half of financial year 2019, which was impacted by unrealized losses attributed to market weakness. We know PIC investors value a fully franked regular dividend stream, and the board was pleased to declare a dividend of 3.2 cents per share. This brings the company's grossed-up dividend yield to a very healthy 8.9%. The dividend will be paid on April 24th, and for those shareholders wanting to reinvest, the dividend reinvestment plan is available. PIC has just marked its 5-year anniversary. This is a key milestone for the company, particularly given the investment strategy is targeted towards a minimum investment period of 5 years. I would like to thank the many shareholders that have supported PIC since its inception, and of course welcome all our more recent investors. While performance over 5 years has been slightly under the benchmark, we are confident in the manager's investment process and believe our active and prudent management of the company will assist us in delivering our objectives. Turning to the board, PIC has a diverse board with deep investment experience who are committed to the highest standards of corporate governance. We have and continue to focus on delivering the company's investment objectives through our rigorous governance processes. For example, Vince is required to attend board meetings and is questioned and challenged by directors on the composition of the portfolio and how it supports the investment objectives of the company. While PIC's performance has been challenged more recently, we are confident in the manager's ability to identify high-quality companies that will deliver consistent performance over the long term. One of the benefits of the listed investment company structure is the ability to pass on franking credits. The franking credits generated through the active management of the portfolio has enabled the company to deliver growing dividends period on period. We know that a regular fully franked dividend stream is valued by investors, and the board takes a prudent approach to capital management to support the payment of sustainable dividends. To this end, the franking credit balance remains healthy, even after the declaration of the half-year dividend. The company also endeavors to keep shareholders informed through the PIC website and our monthly investment update. I would like to encourage you to visit our website and subscribe to our monthly newsletter via email if you haven't done so already. You can also reach out to Karen Davis, who looks after investor relations, if you have any questions. On behalf of the board, thank you for your continued support and interest in PIC. I will now hand over to Vince.
Thanks, Nancy. As you can see, slide 10, many of you may be familiar with this. It summarises our style and philosophy. It quotes our 4 quality filters where all companies that we invest in must be ticked off on these filters. Quality business, conservative debt, especially today, given the issues regarding the economy, coronavirus and trade wars. It's much more important to have a great balance sheet, sound management and recurring earnings. We turn to the next slide. Macro has been playing havoc recently. Let there be no doubt that macro policy, politics and exogenous events have been playing havoc with markets in recent times. Fundamentals have been AWOL, they've been thrown out the window. The Trump shock unleashed the longest stretch of trading days without a 5% correction in nearly a century. Then there was good economic news in solid wage growth, so the market fell because it was addicted to stimulus and it feared its end. Then it recovered only for the Fed to finally tighten policy. And we had the worst December since 1931. The Fed reversed, restored the stimulus, and we had the best January in 30 years. No real stock news or results drove these extremes, just policy. And it got to the point where in mid-February, the US stock market was 158% of GDP. It's a popular measure of testing the valuation of markets, well above its 80 to 100% average, higher even than the 149% in 2000. This recent melt-up in stocks that ended with a thud when coronavirus hit the market is up and down by 3 to 4% as it gauges the impact. Even Joe Biden seems to have helped the market rally last Thursday. No fundamentals, all external shocks. We're not going to turn the pick into a momentum-based fund trying to get the next political or coronavirus shock. We want to be positioned for when fundamentals return. We want to make sure we have stocks which, once all the noise and fury and stimulus clear, have the weight of solid intrinsic value and good balance sheets behind them. The other thing to keep focus on is the debt markets. The coronavirus is already shutting down conferences, hotels and tourism. Yet the market for high yield bonds is remarkably sanguine. Airlines are talking about losing hundreds of billions of dollars this year. And remember, high yield bonds used to be known as junk bonds, and for good reason. At the moment, investors get little compensation for owning junk. But as you can see, when companies that owe bondholders lose money, the bond market starts to demand higher interest. That's a bit of a test for highly indebted companies and companies that lose money. That has been on a borrowing spree for the last several years. US corporate debt is higher than it's ever been in modern times, and junk debt makes up a record share of that number. The duration of high-grade bonds is about 8 years. But when you look at the high-yield index, the junk bond index, that has now fallen from 4 to 2.5 years. The markets can change very fast. We have no preference or liking of high-debt companies, especially ones with junk debt. Right now, the market doesn't care, but one day it may become the only thing that matters. As we turn to the next slide, I think it's necessary that we talk about the coronavirus maybe as a black swan event. Right now, it's hard to gauge the impact. But bird flu is far deadlier, 60% fatal. SARS was 10% fatal. The problem is that it's highly infectious and could therefore affect far more people than these other events. But it's highlighting the risk of outsourcing all your production to one country. The China PMIs are terrible at the moment, but they are already trying to get activity going again. There will be demand and supply disruptions. This will simply roll on throughout the whole year. However, rolling through industries, there will be opportunities to invest in companies that are making a return to normal conditions. In short, we'll have to learn to live with what, if at all, a vaccine emerges, and this will be a rolling event. As we turn to the next slide, the age of extremes, two things to bear in mind. There's always value somewhere in the market, and there's always danger lurking somewhere in the market. For us, the danger is in the tech space at this stage, both in Australia and offshore. Many things rhyme with 2000. Tech overtook financials in the world markets in January. The last time that happened was 20 years ago in the month of January 2000. You can see here that the 5 top stocks make up at least 19% of the US market. The last time that happened was also 2000. The real dangers are stocks that have soared with little or no earnings and often piles of debt. Uber, Afterpay, WiseTech are reminiscent of OneTel, WorldCom and Enron. Some of these are real business models, but the balance sheet and the accounting are something left to be desired. In 2000, a company called Davnet was bigger than Qantas. Does anyone remember what business that was in? Last September, WiseTech was $11 billion in market cap. Crown was only $8 billion. Crown's got a few challenges. We understand that. But it also has hard real assets, no debt, and licenses that run for decades. In the last several months, WiseTech has fallen at least 55% as the market starts to doubt the actual status of the business model. It still remains expensive. So there is danger, but there's always value. Just one example. See on the right-hand side here, you can see the energy stocks versus the S&P 500. They are trading at the lowest level since 1941, when Pearl Harbor was attacked. There is always value somewhere in the markets, and I'll have a lot to say about that later on in our portfolio review. As we look at opportunities, as I mentioned before, there are always opportunities at any time in markets. Of all the global equity markets available to us today for a possible home of our capital, the UK stands out as one of the cheapest markets in the globe. The UK does have large exposure to banking materials, which can partly explain the PE multiple, as you can see on the left-hand side there, at 12 times. But it also does offer good income, with a dividend yield of over 5%. But there are also some globally leading industrial companies listed in the UK. Two of those that we actually own, one being Flutter, which I've highlighted in previous updates, but also companies like Ferguson, which is a leading plumbing and HVAC supplies company in the US. The common theme between these two very diverse companies is both are leaders in their respective industries, and both have valuation support, trading at significant discount to what are domestic comparisons. And importantly, both have either net cash or no net debt, which in times like today provides these companies with advantages during times of economic stress. We've built our exposure to the UK during the second half of last year as debates about a hard Brexit and national election weighed on equity values. In particular, the negativity surrounding Brexit allowed these types of companies to become available at sensible entry prices. Turning to the next slide, talking about the post-Brexit boom, economically the UK has reached a crossroads. The last several years in particular, post the original Brexit vote, you've seen austerity conditions where total spending, government spending as a share of GDP has fallen from 46% to 39%. This has been a drag on UK growth, has led many companies to trade on decade-low multiples, but more importantly, they have maintained very good balance sheets. Post the election in December, and the sweeping majority of the Conservative Party, a shift in the direction of fiscal and business policy is on the way, moving away from austerity towards national infrastructure, builds and tax reform. This could see a significant boost to the potential of growth in the UK. Should lead to, in time, to follow-on multiplier effects across the country as corporate balance sheets of the UK is actually in very good shape. With less uncertainty in the last 2 months, especially pre-corona, we have seen domestic property prices start to rise. And in January, retail sales, which are expected to come in at about 0.8%, came in at double that number, at least 1.6%. So the animal spirits are on the loose again in the UK. Now turning to the next slide, we'd like to highlight one of our investments that we've taken advantage of the market dislocation. That is Lloyds Banking Group. UK assets are still trading cheaply. And as previously mentioned, austerity is giving way to fiscal stimulus in the next 12 months. After we get through the impacts of the coronavirus, fiscal policy becomes an even more important as monetary policy, as monetary policy's effectiveness seems to be waning. UK banks are offering some interesting value. They have underperformed for the last 3 years to the point that banks like our preferred exposure in Lloyds is trading at a 15% discount to book, is yielding close to 7%, and is trading on 7.4 times PE. As you can see, compared to CBA, and is a leading retail bank, it is significantly cheaper. Lloyds is a domestic UK bank only. It has one of the best retail banking franchises in the UK and has a market-leading digital and retail banking franchise, as well as insurance and wealth management. Given what can only be described as extreme valuation differences between CBA and Lloyds, the total return on offer for investing in Lloyds is close to 20%. Now, this does require some fiscal assistance, but the dividend yield is struck off a 50% payout ratio of profit and is therefore sustainable at these levels. So we are being paid to wait. We like how the company is focused on significant streamlining of its cost base while applying a lot of those savings into significant investments in its digital properties of the bank's retail franchise. Now, if I can move to the next slide, we'll look at another stock in focus. Now, this company is La France de Jeux. It is another opportunity we invested in, which represents our single largest exposure at the moment. This is a newly listed ex-government owned lottery and sports betting operator. We were able to buy this company in the IPO, and we actually tripled the position in the first few days of the listing. The government still retains approximately 21% and is expected to sell down in the future. So what do we do? What do we look at? What attracted us to FDJ? Firstly, it has a 25-year license, monopoly license, to operate the lotto and instant scratch cards. They have 45% in the rapidly growing sports betting market in France, but mostly online digital penetration is what attracts us to this. The online digital penetration of lottery games is low by OECD standards, and this opportunity is great for FDJ. It's currently sitting at about 2% penetration online. With online sales, they typically have higher margins, and a move online should enhance future earnings growth for FDJ. Also, FDJ does own and develops its own lottery technology platform and technology stack, which it does actually sell to other lottery operators globally. So more margin is kept rather than being paid away to third-party technology suppliers. Another factor we really very much appreciate in FDJ is the financial strength. It's a rare company in that It does have infrastructure-like tendencies, as lottery businesses do, and it has a net cash balance sheet. It has no debt, is net cash, as most companies globally that are lottery-based carry significant levels of debt. We're achieving approximately about a 4% dividend yield on the stock. It's trading at about 22 times PE, but is growing at about 15% a year. But more importantly, we expect to see efficiency improvements as a newly listed company with a focus on game development and cost and technology synergies, helping grow the business over the next several years. If we turn to the next slide, this is another investment opportunity we took in the second half of last year, a calendar year. It's called Elders. Elders is an Australian agribusiness company. It represents a one-stop shop for the rural industry. It has a great brand, and with the merger of two of its largest competitors, Landmark and Ruralco, has improved industry dynamics for the better. The opportunity arose due to the East Coast drought, which put pressure on rural activity through calendar year 19. This led to a downgrade and significant price fall, and this provided us with an attractive entry price on 9 times PE if we normalise back to normal growing conditions. Given that Elders can be quite cyclical, a strong balance sheet is necessary, and this has allowed Elders to continue to acquire some good businesses to infill the network during the low point of the agricultural cycle. And given the significant rainfall that has occurred, the probability of a strong winter crop has risen significantly in the last few weeks, and what should follow is strong profit growth. If we turn to the next slide, we'll look at the asset allocation of the portfolio as it stands as at the 31st of January. Fully 88% invested. Of that, 67% is invested in domestic stocks. Might have mentioned just recently, that was a newer position. 21% is in global, and remember, for this strategy, we can go up to 25% of the strategy in offshore stocks, and currently 12% in cash. Moving on to the next slide, I think it's necessary that we discuss the performance, in particular in January, which was one of the worst months we've had since the listing of the PIC in 2014. During the month of January, as I walk through the performance, during the month of January, our international exposure, in particular our 24% exposure to the UK, cost us, as the UK market actually fell 5% in January, while the Australian market rose by 5%. That 10% opportunity cost, and being long the UK represented about 200 basis points or 2% of the underperformance we'd added to our exposure in the UK during the month. Also, in this month, CSL rose 7%. It is our single largest underweight. CSL rose approximately 7% to 8% during the month, again, costing us approximately about 50 basis points on a relative basis. We have no exposure. It is a great company, but it is trading on 45 times PE multiple. This actually is outside our comfort zone. Also, we have an investment in a company called Mosaic, which is the old Noni B Fashion, which is a fashion retailer, and due to the bushfires, where it has up to 27% of their stores in regional areas, was affected by the bushfires and issued a profit downgrade in January. This led to an actual 40% fall in the share price, costing us approximately 40 basis points. And lastly, due to the market rally domestically in January, our cash position, which is approximately 11 to 12%, with a 5% rally in the market, cost us a further 50 basis points. While this has cost us during the month of January, we used the underperformance to add to these positions. Also during the month of January, we utilised a record low level of volatility to purchase some index puts to protect our downside if the market should fall, as insurance against the falling market. These puts have done a great job in the last 2 or 3 weeks, as the market has fallen, providing a part buffer to the fall in the market and our NTA. I'd like to hand back to Karen.
And thanks, Nancy. Now we'll go to the Q&A. We've had a bunch of pre-registered questions, so we will get through as many of those as possible. But just a reminder for those of you that have dialed in via the telephone, you can also ask a question now by pressing star key followed by the number 1 on your keypad. Or if you've dialed in via the webcast, you can also ask a question by clicking on the top right-hand corner of your screen on the Ask a Question button. So we might go to some of the pre-registered questions, and also we have had one question from Tony online just around whether or not the slides and the audio will be available. The slides are already available on our PIC website, and later on the audio will be available, including all the Q&A, so you can also listen to it again if you would like. But firstly, maybe we'll just turn to the topic of the day, or the topic of the last few weeks, the coronavirus. Vince obviously touched on it in his presentation, but Vince, maybe if you can just also reiterate your thoughts on the coronavirus.
Thanks, Karen. So our general thoughts are initially coming out of China, we've had obviously a supply shock as the industrial base sort of closed for longer than the typical Chinese New Year period. And our main concern when we were looking at our portfolio was that a lot of the companies we own, such as GUD, which does get supplied from, which makes brake liners, etc., and pads and etc., and air filters, etc. They've got quite a few automotive products. Whether their supply chain will be disrupted, we spoke to the company on Friday last week, and they informed us that most of the supply, they've also got very diversified supply base in other countries. They mentioned that their supply base is actually back up and running, not at 100%, but they're up to 60, 80% in that range. So that gives us some comfort regarding some of our positions on supply. Now, moving to where it's occurring in the West, now that's going to be more of a demand shock rather than a supply shock. And how are we buffered against that? Now, I talked about our quality filters that we look at, in this environment, you definitely want to be in companies with very good balance sheets, because they can actually get through a demand shock like this and actually hopefully take advantage of those that don't plan for rainy days. A lot of our companies have net cash or no debt, and will be able to take advantage of any sort of demand shock to either take market share or just survive while others may go to the wall. Also, we're running quite a bit of cash at the moment, plus, as I mentioned before, the put options we have on the market are proving to be quite valuable at the moment in protecting our downside.
Thanks, Vince. We might also turn to Nancy now briefly. We've had a question or a couple of questions on the share price to NTA discount. Did you want to comment on how the board's thinking about that, Nancy?
Yeah. Well, typically, as most of you are aware, the key factors that would drive the discount or the premium to NTA are performance, dividend yield, and investor communications. The board has focused on continuing to deliver a strong, consistent dividend yield. And as of December 31st, the annual dividend yield is 6.2% and a gross dividend yield of 8.9%. And we have continued for 5 years to pay a solid dividend, and keeping in mind that franking credits are very important to our investor base. As to the communications, we've actually done a lot of work on the website. We've done a lot of work with producing a monthly investment report and an NTA report, and we've tried very hard to be as transparent as possible about the stocks we own in the portfolio through the roadshow and our half-yearly results. On the performance side, Vince, do you want to talk about that? Pretty much we're sticking with our investment policy and waiting for the fundamentals to return.
Yeah, so as I mentioned earlier, January was quite a poor month for us. This month's proving to be a little bit better, as I said, because we were reasonably defensively positioned because of our cash weighting. And when we purchased, we did buy the options in January, so the implied volatility of the market was quite low. So the cost of the option was quite low as well. We've been able to maintain our downside protection through that. But look, in markets that tend to sell off like this, it catches a lot of companies, a lot of good companies get thrown out with bad companies. That's why at this point, having the flexibility as we have today, we can actually pick off some companies we've had our eye on for a little while, but we just couldn't get comfortable with the price paid to get in. So as Nancy mentioned, hopefully we go back to fundamentals. And I think in fundamentals, people were ignoring balance sheets quite a bit in the last. There's a lot of concept businesses which were brought to market in the last 12 to 18 months. A lot of businesses that had no balance sheet, didn't generate any free cash flow, but were reliant on the good graces of the market to finance them going forward. In these sort of markets, those businesses have had no access to capital. So we're fortunate that we have owned companies that generate a lot of free cash flow and can finance themselves through any cycle.
Thanks, Vince. We've had also a question from Michael regarding whether or not we still own URW. Do you want to maybe just explain who URW are?
So URW is a Dutch-French combined with the old Westfield Group. They took it over a few years ago, over 2 years ago, sorry. And which is a collection of Australian retail malls, US, majority France, Europe and Eastern Europe, and 2 malls in the UK. Now, they're a manager of those malls, they develop those malls, etc. Now, we used to own them. We're actually out of URW at this stage, which is a recent development, and we haven't reinvested those proceeds yet. We just, as I said, we've added that to cash, and we're just waiting out for our time to invest back in the market.
Thanks. And just another question from Michael. I'll ask Nancy to handle this one. He's asked whether or not the dividends available in the dividend reinvestment plan will dilute the NTA or water down the NTA.
Yeah, Michael, we actually have a very small number of investors participating in the dividend reinvestment plan, and you probably noted that we will not be reinvesting at a discount as well. So it should be probably fairly immaterial to the NTA. Do you want to talk about the dividends and the franking credit balance while we're at it?
Right, yeah.
Just following on from that, the franking credit balance as at December 31st, 2019 is $8.63 million, which would allow a maximum payment of a fully franked dividend of 5.8 cents per share. That balance will reduce to $3.87 million after the payment of this 2020 interim dividend. The franking coverage for the payment of fully franked dividends right now is approximately 1.8 times. I usually get that question on these things. So that's for the payment of a fully franked dividend if we continued at 3.2 cents for the final dividend of financial year 20. So effectively, we've got quite a good reserve there going forward.
Excellent. Thank you, Nancy. We did have a question come through on the phone as well from Gordon. We might take that phone call or question.
Oh, good day. Can you hear me?
Yes, we can. Thanks, Gordon.
Hi. Thanks very much for taking the call, and well done, Vince, on managing the portfolio through these crazy times. I just noted your comments around Lloyd's and the payout ratio, and also that you own both ANZ and Suncorp in the portfolio. I guess we were wondering, given the current economic situation, how comfortable you feel around the dividend payouts for those domestic banks, and also just comments around capital for the domestic banks, obviously in a far better position than through the last down cycle. How you're thinking about prospective and capital raises, etc.
Okay, thanks, Gordon. So on the dividends, Suncorp, they're in a position of excess capital due to the sale of part of the life business. So I'm actually quite comfortable with ANZ's ability to pay the dividend. Now, with ANZ, I think they're okay. We did some modelling internally where basically you'd need a pretty significant increase in bad debts, a doubling of bad debts in the next 12 months. Now, whether we see that, this is with the virus, it's hard to call. It is, as I said, it's a demand shock if everything sort of shuts down for a period. Whether you'll see it like a doubling of bad debts, I think that's quite an aggressive call. I don't think we're going to probably see that. Specifically because also I suspect we're going to get some form of, as I mentioned before with the UK, there's probably going to be some fiscal response by the government. They've all sort of like intimated that in the press. That can sort of get us the economy through, but I suspect it won't be immediate. Excuse me. So I'm actually, with ANZ, I think we're okay. As I said, you need a pretty material doubling of losses for that dividend to be cut. Again, with Lloyd's, very comfortable with it, and Suncorp, no problem.
Fantastic, thank you.
And on capital as well, The banks are, in rude health on capital basis. I'm not that worried about capital raisings with the banks. I suspect if push came to shove and the aforementioned loss rate started to lift, they'd probably cut the dividend first. The Australian banks, I think, and all four of them pretty much together. You can throw a blanket over them regarding that, but we're not really calling for that at this stage.
Excellent, brilliant.
Thanks for your question, Gordon. Turning now to a question we had earlier from Max. He's asked, are the operations of any businesses in which the funds are currently invested adversely affected now or likely to be at risk in the next 6 to 12 months? So quite a broad question. Yeah.
Based on anything in particular, on Corona or just in general?
Just a general question, I believe.
Look, it's a bit hard to call because everything's going to be affected by any demand shock. So any slowdown in the economy, you're buying equity, so you're going to be exposed to some layer. But as I mentioned before, and I know I'm harping on a bit about this, when you've got a good balance sheet and you can generate some free cash flow, you can get through these moments where there are short-term or even medium-term impacts to an economy. I'd really be quite frightened. When I look through our portfolio, a lot of our positions are zero debt or net cash, are a little bit more defensive to market, less sensitive to the underlying consumer in some levels. We've got we've got a very large exposure to agriculture. I mentioned Elders, but we have built a position in GrainCorp as well, and that tends to benefit from, it is raining. It's actually quite interesting that the agricultural sector could be one of the only sectors that actually has earnings upgrades in the next 12 months because it's idiosyncratic to the rest of the market. Its risks are very divorced from the market cycle. So we've got some protection there. Resource position we've got some Iluka, but again, it's got a good balance sheet. They've announced a split of the business into Mining Area C, a royalty company where you'll be getting a dividend from that. It'll be 2 pieces of paper. Again, balance sheet okay. It does get impacted by demand changes, mostly from China, but China will be stimulating, I suspect, in the next 6 months like the rest of the OECD as well. So there's no absolutes in trying to work out which companies are very protected. So it's more about, for us, is finding a quality business with a really good balance sheet. That'll get you through and typically do better on the other side.
Thanks, Vince. I think you've probably touched on this a little bit already, but just to make sure we cover off this question, we had a question from Bruce around how would the funds help protect our investments in a bear market?
Again, I hate to sound like a broken record, but having good companies that generate profit today, back to our 4 quality filters, but a great balance sheet. More importantly, we've got a reasonably high cash weighting today, as well as the put options. They are sort of cushioning some of the blow of the market selling off. And again, as a personal investor in the fund as well, most of the companies we own do have quite a healthy dividend as well. And to that point, we do focus on the ability, the payout ratios of the company. They're not paying over 100% of their earnings out, because if you get a demand shock and your earnings go down, your dividend's going down. So, I look at Crown today at $9.65. It's got a locked-in 60-cent dividend for the next 2 to 3 years, and potentially will be in a net cash position once Barangaroo Sydney's open. So, which is quite unusual for a casino stock. I look at those sort of things going. There's actual value on offer in the market today. We're adding to sort of positions like that.
Great, thanks, Vince. Another question from Michael, just asking if you could comment on the weakness of index funds versus active.
I really don't know where to take that. Index funds versus active. Well, the index is it's copying the market. So you basically own everything, and if the market's going down, you're getting exactly the market return. Hopefully with active funds management, you're getting something slightly different that in maybe, as I said to you before, in January we had one of our worst months because we weren't participating in what was pretty much straight multiple expansion or PE expansion. Whereas today we're in a net cash position in the funds and long index puts, and some of our positions are reasonably defensive as well. So that hopefully that active management's helping not give you a market return, whereas you're going to get an index return. no matter what they do.
Great, thanks. Thanks for your comments, Vince. We've had a question today also from Dermot regarding Nancy, if you foresee a capital raising for PIC over the next period of time.
Not at today's prices, huh? The company does not currently have any plans to raise further capital. I'm going to work very hard to try to get the price up to the NTA. That's really our focus at this time.
Thanks, Nancy. We did have a question also from one of our investors, just asking you to comment, Vince, on the ASX 300 today and what's going on, and also a question around where our share price will be. Obviously, it's probably not something that anyone can predict, but I'll hand it over to you to have a go.
Well, the ASX 300, well, it is obviously like a mild panic going on at the moment. I think that if you look at what's happened in the oil market over the weekend, you've had what typically the OPEC, when the oil price starts falling, OPEC tends to get together with Russia and they tend to cut production, and what's happened is the complete opposite's occurred. They haven't cut production, and then the Saudis have come out, Aramco have come out and actually increased production to take back market share. That sent the oil price down to $36 odd from $40 odd, $43 last week on Friday. And that tends to panic markets when you see such wild gyrations in things such as oil. For us, that's something you can't try and foresee or work out what's the next move. It's more about politics and geopolitics. All we're trying to do is, what does that mean for, again, if you have any oil exposure, and we do own some Origin, it's got a very good balance sheet. Majority of its earnings comes from its Australian retail energy business, electricity provision effectively. Has some renewables there as well. So that's our oil exposure. We don't own anything else that's oil linked other than that one, because it's got the best balance sheet out of the bunch of them. Why the ASX is reacting this way? Well, what you're seeing is, if you look at the yield curve and the bond market is incomplete, it's rallying quite strongly. And you're seeing, as I came back up from the desk, you're seeing the US 10-year down to 55 basis points from 77 on Friday. So there is, like, you can tell this is a day of panic when people are behaving that way. Why would you be willing to earn 55 basis points over the next 10 years is beyond me. So this is a day where you've got to use some of your money and start spending some money. That's my view, is that you start to add to buy some market risk today, because things are on sale a bit. That's what we're doing today. We're looking at some opportunities and adding to our positions, and some newer positions we're bringing to the PIC.
Excellent. Thanks, Vince. And thanks, Nancy, for your time today. We might start to wrap up there. There's not too many more questions coming through, but just a reminder to everyone, thank you very much for joining us. We do release the daily NTA on our website, and there's a wealth of information on the website, so I encourage you to have a look. We release our monthly report every month with portfolio commentary in there on particular stocks, etc., which is also downloaded on our website and available around the 14th of each month, so please look out for that. We do encourage you to have a look. So thanks again for your time, and we'll wrap that up.